And on Friday, MBS were up 11 basis points in the morning, stocks down 27 points. European PMI numbers were weaker overnight, with the services sector in France and Germany leading the way. France came in at 48 on a 52.5 forecast. Germany came in at 54.1 on a 57 forecast. That sparked a rally in European bonds. It spilled over to a 6 basis point rally earlier in treasuries. Bonds pushed back to a slightly weaker direction at the 9:30 New York Stock Exchange open. The 9:45 PMI data didn't really contribute to any directional movement, even though the volume surged and modest selling continued. S&P Manufacturing PMI, which is the Production Managers Index, came in at 46.3 on a 48.5 forecast, showing that things are slowing down a little bit. It was 48.4 previously. Services PMI came in at 54.1 on a 54 forecast. It was 54.9 before, so slowing down a little bit, but not as much as forecast. Manufacturing is in a contraction while services are still expanding, which is something Powell talked about this week. Inflationary conditions continue to ease, with firms increasing prices at the slowest pace for a while. The index of leading economic indicators declined again in May, signaling that a recession is in the cards. Rising interest rates paired with persistent inflation will continue to further dampen economic activity, while we revised our Q2 GDP forecast from negative to slight growth. There is a prediction that the U.S. economy will contract over the third quarter and first quarter of next year. The recession likely will be due to a continued tightness of monetary policy and lower government spending. Friday began with a solid gains courtesy of weak PMI data in Europe overnight and some follow-through with U.S. buying. Seller surfaced again at 9:30 after the PMI data. The net effect of the transformation of a strong rally into an uneventful rally by midday. Treasuries gave up just over half of the overnight gains and stayed flat into the 3 o'clock CME close. MBS were slightly more volatile, but only superficially due to illiquidity. Modest gains leave bonds in the prevailing range and leave us waiting for a confirmed breakout from that range. The other day, we're up almost a quarter of a point at 99.91. Stocks lost 33 points. But at the 99.91, we talk about that range as we've been staying in this range right between that thick black Fibonacci line at 99.845, which has kind of converged upon the 25-day moving average. We have so much data around that Fibonacci that basically the 25-day moving average is flattened out at that. Then we have a ceiling where it's kind of another convergence of the 200-day and the 50-day moving average are all kind of converging upon each other at the 100.27, but it seems like we got about half the players that want it to be below that Fibonacci line and half that want it to be above it. But in things you can control, check out our sponsor at thatmakesense.com. This is from a podcast series by Chris Williamson with Alex Hormozy, which is all about opportunities only look like opportunities in the rear view. So regretting the opportunities not taken, our opportunities only look like opportunities in the rear view mirror. So we look at risk. So this is one of those things where things always look better in hindsight. So you can't avoid risk. Money in your mattress is a risk. So you can't just look for things that are risk free. And it gives you some good ideas of proper ways to look at risk. Speaking of risk, looking into next week, we have a bunch of data coming. Although not everything is a market mover, but then again, lately everything can be a market mover. The big ones are on Tuesday. We get durable goods order and core capex. We also going to get some home price data there. And then at the end of the day, we have a 5-year note auction. We also have on Wednesday, we got a 2-year note, a 7-year note individually. Not that big of a deal, but 2 auctions in a day will give a sense of what's going on in the bond market. Thursday, jobless claims, always a big one people are looking at nowadays, and the GDP numbers, as well as pending home sales. And then on Friday, you got the core PCE inflation, as well as consumer sentiment and University of Michigan conditions. So later in the week, we get a lot more data. But over the weekend, check out some common sources and influences, particularly our sponsor at thatmakesense.com.